All right. Hey. Welcome back to the Invested Dads Podcast, a podcast where we take you on a journey to better your financial future. Today, we are going to be talking about bond convexity. So it's essentially the nonlinear relationship between bond price moves compared to interest rate moves, and then the implication that brings about to its implied duration.
I'm going to have to go with a no on that one.
Why?
Veto that topic.
It's your dream topic.
As much as I love convexity in general,
Well, of course.
and bonds being the most convexity-loving piece of my life, I'm going to have to go with no. By the way, that's not even what this meeting is for. If you would look on your calendar invite, we are not doing a Invested Dads podcast. We are doing a monthly video.
I thought that camera was just there to show our wives that we are more than just great faces for radio.
That's incorrect. We are doing a podcast, and this is Josh Robb and Austin Wilson from Hixon Zuercher Capital Management, and we are here for the February economic update.
True, February.
That's right.
Yeah, so, all right, Buzzkill, Josh Robb over here. We are also known as the Invested Dads from the Invested Dads podcast, so check us out if you are on your favorite podcast player. We are there. But don't think this is getting you, Josh, out of a discussion about convexity one day, because
someday
we'll hash that one out. So let's kind of enjoy looking back at February and talk about what is going to happen potentially here in March and going forward. So the month of February, it was mixed for the U.S. stock market. The tech-heavy NASDAQ was actually down 1.6%, while the S&P 500 was up 1%. And the Dow Jones Industrial Average, it was up 2.4%. So that rotation from growth to value that started last fall, it was in full swing in February. And that's actually continued to the time of this recording in early March.
Yeah, that was a 4% difference between NASDAQ and the Dow Jones.
Yeah, it was a big difference. And one of those big drivers has been the sharp move higher in interest rates. So, for example, the U.S. government-issued 10-year bond was trading at a yield of about 1.1% at the beginning of February. By the end of February, the yield has actually increased, really through selling bonds, by about 40%. Now, that was a very low base, so take that with a grain of salt, but that put ending month yield at about 1.4%. So you might ask,
what's a convexity?
That's a good question. But let's go a little higher level than that. So, well, Austin, how do interest rate increases impact the stock market? So let's dig into that just a little bit, because it has surely impacted February and March results as it relates to the stock market, and we think that you should know a little bit about what's going on. So the answer really has everything to do with how stocks are priced. Stocks are priced based on what investors believe that future earnings and cash flows are worth in today's dollars, or what's known as discounted to today. The discounting process uses yield as the discounting factor. All other things equal, higher interest rates make future earnings worth less today. So, low interest rates, they're a tailwind for equities in general. And the faster the growth that's built into the model, the more of an impact an increase in rates is going to have on stocks' valuations. So this is why more growth-oriented areas of the market were hit harder in February. But in fact, banks are more of a value style. They actually did okay because interest rate increases help them as they earn more on net interest income from the debt that they issue. So yeah, that is kind of why and how we got to be where we are today. Through February and actually into March, it has continued.
Yeah. So really, that rise in yields has been one of the sharpest rises we've seen in quite a while.
Yeah.
Because, back in 08-09, the Fed did the same thing where they dropped the federal funds rate down to 0.25, practically zero, and which brought other rates down. And they slowly started raising that back up. So that was kind of a slow, gradual rise. What we've seen here is a quick drop, but then as the economy seems to be improving, we've seen the interest rates head back up. And we also probably think that the potential of the new $1.9 trillion stimulus package, which is being voted on, and will probably be passed by the end of this week, will probably have an impact as well, because that's a lot of money being put into the economy.
Right, and you're going to dig into that in just a little bit. But I guess when you're talking Fed funds rate versus Treasury interest rates, there is a bit of a disconnect because the Federal Reserve, Federal Reserve Chair Jerome Powell has said many, many times, even recently, we're sticking the course at zero, essentially.
Yep.
Now that's really short term, like overnight lending rates, like very, very short term. And what happens is they can hold that, but then based on the demand for bonds, going out for longer term bonds. As the demand for that drops, their prices come down, and that's what sends yields higher. So that's really an anticipation of good economics in the future, because people are getting out of bonds, which is a safe haven, and going into equities, generally speaking. So yeah, it has been a wild move. But Josh, kind of dig in a little bit more on that stimulus bill that is, as we're sitting here, it's being voted on as we're sitting here recording this.
Right. Yes.
But for all intents and purposes, it seems like it's going to pass.
Yeah, they seem to have the votes in the House, and as long as they don't make any changes, then it will go to President Biden's desk to sign, which he's already indicated he will do.
Absolutely.
And so we'll look at that real quick. And again, for more details, we actually have a podcast on the stimulus bill where you will have the opportunity to get a little deeper into there. But from a high level, the most important thing people are wondering about is those checks.
Yeah.
And so in this stimulus bill, $1,400 per person, which is a little different in the past. When I say per person, that includes dependents, will also get $1,400. And they've expanded the dependents to include college age and elderly. So if you claim someone as a dependent on your tax return, they qualify as a $1,400 recipient. Now, the person actually filing the tax return is one who'll get all this stimulus money, because the dependent actually won't receive the check themselves, but they will be added to that total and be given to it.
Right.
The other thing to note is they've adjusted the threshold. So for a single person, it's $75,000. For head of household, it's $112,500, and for married filing jointly, it's $150,000. They've also shortened that amount of income before you're totally out of receiving any stimulus, which is about $5,000 for singles, and then another $10,000 for married filing jointly, or $80,000 for singles and $160,000 for married filing jointly. So that's the range between when you get full stimulus to get no stimulus is right there.
And that those income limits and thresholds, those are based on whichever the most recent tax filing you have. So for a lot of people, it's March, your taxes aren't due yet. You may not have filed 2020 taxes. A lot of that's going to be based off of 2019. But if you have filed 2020 taxes, they will use 2020.
Yep. And so it's whatever they have the most recent filing on. You're correct. A couple things in the bill. There's a lot in there. There's like 500 and some pages in there.
I think it's 5,000.
5,000 pages? Oh, that's a lot. Child tax credit. So for 2021, for kids 5 and under, they're going to increase the tax credit to $3,600. If for a kid from 6 to 17, you get $3,000. Now, what's interesting is they're actually in the bill wanting part of this to be paid in some sort of maybe monthly or quarterly, however the Treasury Department can do it, but some sort of payments ahead of the actual tax of 2021, which is done in 2022. So, let's just say they can do half of it. So, $1,500 for that second grouping would be paid monthly, and then the rest would come as a tax credit. So they're trying to get more money to parents to help offset some of those costs.
The Democrats who put this as part of the bill together, they said that particular spacing out of the child tax credit and this amount could reduce child poverty by 50%. So I think we can all agree, regardless of where you stand, with child poverty, we want to go down. So,
so the hope is, getting some increasing the tax credit for one, and making it more likely that more tax filers can receive it has been big, and then giving it to them ahead of time, they don't have to wait till the tax filing to get some of that money is great. Unemployment was another change.
Yes.
So originally this bill had $400 a week additional federal unemployment. They moved that down to $300, which is part of why the House has to revote. And so if they pass that, $300 additional on top of your state unemployment will be available. And they extended that through September. And then the other thing that's interesting is $10,200, because
round number, of course.
You love those easy numbers to remember. Will actually be tax free from unemployment. Yeah. So unemployment is federally taxed. Each state is different on how they tax unemployment, but federally, unemployment is taxed.
Right.
And they found more than half of the people who claimed unemployment last year did not withhold taxes. And so the worry was, come tax time, they would get this large bill and they didn't have any money to pay for. So they said the first $10,200 is tax free, and based on what I understand, that includes 2020.
Right.
So if you've already filed, I'm not sure what that means right now, but if you haven't filed yet, it may be worth waiting just to get some more issuance from the IRS on what that means. And so interesting to see, but at least for 2021 unemployment, we know that will be a part of it as well.
And some provisions we're not really going to hit on. There was money in there for state and local governments. There was money in there for schools. There was extension of paycheck protection program provisions. There's a lot of money in there for COVID-19 testing and vaccine distribution. So those are just some of the headlines that are in there. But like Josh said, if you want to know more about that, we have a full dedicated episode for our podcast, the Invested Dads podcast, that recently came out where we just talked about that. So take a listen and check that out.
All right, so what's next? What happens? We talked about February, looked at this stimulus. What do we have?
Yeah, so, $1.9 trillion seems likely to go through. For all intents and purposes, it's going to pass. So we're just going to assume it's going to pass, and we're going to be watching this. This is going to have an impact on the economy. So, first of all, it's going to have a good boost. People are going to have more money in their pockets, and hopefully they're going to be spending a little bit of it, and that's going to cause businesses to reopen and hire people and all of that when you build it in with the fact that COVID numbers look better and better all the time. But some things to watch, are the fact that we are doing this largely out of debt. So $1.9 trillion of essentially more debt for our government that, while a lot of people would like to say it's not a big deal, it's going to become a big deal at some point because it's just unsustainable at some point. We're going to have to pay the piper one day. Number two, it's widely assumed that this money going into the economy at some point, whether now or in a little bit or down the road, is going to cause inflation.
And $4 floating around.
Exactly. Yeah. People are going to spend it, prices go up. So what that inflation is going to do is it's going to eventually prompt the Federal Reserve to lift short-term interest rates, increasing borrowing costs. But what's that going to do again? It's going to put pressure on valuations of the stock market because, again, those future earnings are discounted at even a higher rate. So there could be some volatility in the future from that. But those are kind of the things we're watching about what's next. As far as COVID goes, things are looking much better around the country. In fact, the U.S. is doing better than the rest of the world in terms of seeing a decrease in cases amidst an increase of vaccinations. And so we're kind of leading the way there. And I think that's a very good thing that's going to help our economy over time. So that's kind of where we're at looking forward.
Well, thanks for joining us for our February market economic update. As a reminder, nothing we said today is a recommendation. Please talk with your financial advisor before making any investment decisions. If you do have questions or would like to talk to us, please give us a call at 419-425-2400. We'd love to talk with you.
All right. Have a great month.
All right. Talk to you later.